So here's a puzzle for you. Gold is supposed to be the ultimate safe place to park your money, right? So why in the world is its price falling off a cliff during a major global crisis? It's a question that has a lot of people scratching their heads. Today, we're going to pull back the curtain and show you the hidden, mechanical reasons behind this crash.
All right, let's just dive right into this paradox. You've probably seen it all over the news. Everyone's asking the same question. If gold is our financial emergency exit, why is the door jammed shut right when we need it most? Well, the answer, according to our source material today, is probably not what you're thinking. So the story you're hearing everywhere basically goes like this. Inflation is hot and the US dollar is super strong. The argument is that a strong dollar is the new king of safe havens, which makes an asset like gold, which doesn't pay you anything, look, well, a lot less shiny. That's the standard textbook explanation. But our source today, Finance Blaze, says that this whole mainstream story, it's just missing the point completely. They argue this isn't about the fundamental value of gold changing at all. Nope. What we're actually watching is a really violent, purely mechanical event that's playing out behind the scene. Now, before we get to what kicked all this off, you absolutely have to understand the main character in the story, the systematic hedge fund. Look, these aren't rooms full of traders yelling buy and sell. Just imagine massive funds run entirely by computer programs, algorithms that automatically trade billions based on a set of pre-programmed rules. No emotion, no gut feelings, just pure code. And this slide right here, this lays out the entire chain reaction. It's like a row of dominoes. First, you get a major geopolitical shock. That sends oil prices through the roof. Now, that kind of shock creates panic across the financial markets. The instant that happens, the algorithms, which remember, don't think, they just react, hit their preset tripwires. Their programming screams danger, and they automatically start dumping huge amounts of paper gold. That sudden price drop then forces smaller investors to sell, which just pushes the price down even more. It's a brutal downward spiral. The source actually calls this whole thing a perfect trap. See, after a big price run-up, a ton of smaller, less experienced investors jumped in, often using borrowed money to chase the trend. This setup allegedly creates the perfect environment for a liquidity flush, a sudden, sharp move designed to wipe out all those weaker players and shake them out of the market. Okay, and this slide, this is really the heart of the entire argument. You have to get this. There are two very different gold markets. First, you've got the paper market. That's futures contracts, ETFs. You're basically just renting a claim on gold. It's driven by algorithms and tons of leverage. And then you have the physical market, real bars and coins in a vault. That's about owning a real asset. There's no leverage, and its price is a truer reflection of actual supply and demand. You know, what's so fascinating is we have seen this exact movie before. Think back to the 2008 financial crisis. Gold got hammered at first, dropping about 30%, because big institutions were dumping their paper contracts to get cash. They flushed the market, shook everyone out. And what happened next? With the paper market reset, gold started a monster 3-year run to record highs. It's the same playbook. So here's the bottom line. While the paper market is caught in this violent algorithmic storm, the physical market, the one with actual real metal, is telling a completely different story. And you could argue it's a much more important one. So what exactly is happening there? Let's look at the hard data. This chart shows us the registered gold inventories at COMEX. That's the actual physical gold sitting in the vaults ready to be delivered. Just last April, there were over 24 million ounces. Look at where we are today. It's a pretty steep drop. That is a 31% drop. Let that sink in for a second. In less than a year, nearly a third of the physical gold available for delivery has been drained from the vaults. It's literally disappearing, even as the paper price is cratering. So where is all this physical gold going? Well, guess who's backing up the truck? Central banks. They're on track to buy over 800 tons of physical gold this year. Countries around the world are hoarding the real stuff.
They seem perfectly happy to let these algorithms push the paper price down because it just means they get to buy the real asset at a huge discount. So, to bring it all home, this quote really hits the nail on the head. Today's price crash isn't some grand verdict on gold's value as a safe haven. No. According to the source, it's a violent mechanical reset. It's what happens when a super crowded, highly leveraged trade smacks headfirst into a wall of automated selling. So, what's the big takeaway from all of this? It's really about seeing the market through a different lens. It's about understanding that huge difference between a paper promise and a physical asset. And it's recognizing that when algorithms are at the wheel, short-term prices can get totally disconnected from the real story happening underneath. And all of this leaves us with one final, pretty provocative thought. In this tale of two completely different markets, one where computers are crashing the paper price, and another where physical metal is flying out of the vault, who do you think is really in control of gold's true value?